So it's quite a month we've been having in markets so far, isn't it? There's just a lot of uncertainty in the world. We hear about the Federal Reserve and interest rates, how high and for how long are they going to remain high? Oil prices have started to go up again. That doesn't seem like good news. We've seen a little bit of dysfunction in Washington, D.C. No one seems to know how to keep the government open. That's a little discouraging. We'd like to see some better leadership. And then this thing in Ukraine is still going on with Russia and Ukraine having this conflict. You know, it doesn't feel like the world is getting any more certain. So at times like this, investors ask, well, what should I be doing right now in my portfolio based on what's happening in the world? We think the most important thing is maybe to look at 5 key investment principles and just make sure that our approach to our portfolio and our financial plan is really reflecting the things that are most important. Principle number 1 for us, and I think it is the most important principle, is we want to construct our portfolio based on our financial plans. What individuals and institutions should be thinking about is what is their financial plan? What are their goals, short-term, long-term? And as they think about that plan and construct it in a detailed fashion, it will help the construction of the portfolio so that assets are selected to specifically meet or contribute to the success of the goals of the plan that the investor has in mind. Now, plans can certainly change, and we would expect that over the course of any investor's lifetime, their plans will change. But the reason they change really should be around maybe your goals have changed or your circumstances have changed a little bit. The thing that should not be changing our plans is what's happening in the market today. The same thing would be said of our portfolio. The thing that should change our portfolio is not what's happening in the marketplace today, but if anything changes in our portfolio, it really should be driven because our plan is changing, again, because our goals or our circumstances have changed. Isolated from that, hey, this is happening in the market today. A lot of things happen in the market every day. The market is never as certain as we'd like, which is why principle number 2 is so important, is we need to be able to embrace uncertainty. You know, uncertainty in the world is really kind of the water that we swim in. It's the air that we breathe. If you think about this idea of embracing uncertainty, really what we're saying is my health is basically uncertain. I do things to try to raise the probability of having good health, but I can't have it with complete certainty. Political outcomes are uncertain. What happens in the market from day to day in terms of interest rates, stock market returns, those things are uncertain as well. We think about the sporting teams that we root for. Certainly the results from this weekend and the next weekend, well, they're uncertain. It's just part of our life. The idea here is when we're embracing uncertainty is what we're saying is I'm not going to try to fight that. I'm not going to try to change something I can't change. Rather, I'm going to embrace it and say, in light of this uncertainty, what should I be doing? And there are a couple things that I think about there. One is let's recognize that uncertainty actually can be a positive for investors. Oftentimes, long-term investment returns, well, those expected returns are higher when an investor chooses to take some risk, to accept some uncertainty. We don't want to do that across the board in all aspects of our portfolio, but some of the parts of our portfolio are designed for long-term goals, and we need returns greater than the rate of inflation. Well, we may need to be more invested in stocks, which are less certain than holding bonds and cash. The other things I'd say about embracing uncertainty is I think it's just going to give us a little better attitude as we face each day. Because if we're fighting uncertainty, what we're trying to do is we're trying to fix something that we just can't fix. And the more that we try to fight uncertainty, the more worried and anxious we're going to get because we're going to be fighting something we can't change, and that can be frustrating, as opposed to embracing it, saying, this is the water I live in, I'm planning in light of it, I'm going to go forward understanding that uncertainty is just where I am. Okay, the third principle that I think we need to understand is trusting markets. Now, trusting markets sounds a little strange because markets are very volatile and you're thinking, well, is a market really trustworthy? Well, what I mean by trusting markets is not so much that the market price right now is a great predictor of what's going to happen tomorrow or even the next hour. Really, when we talk about trusting markets, what we're saying is historically those markets have been great arbiters of risk as well as providers of return. Now, why is that? Well, markets represent the place where investors come together, millions of them, and they kind of have their opinions and they make those decisions based on opinions. And the marketplace is a place where we see the wisdom of crowds come together to create market prices. And over time, it manages risk fairly well and again, provides that return. So we think that trusting markets means making those markets our ally. We want to team with markets to try to get that return as opposed to compete with the market and possibly lose to it. Why would I want to lose to something that I can join with and have a really decent investment experience, especially when you look at things historically? Now, 4 and 5 principles are kind of related: advancing with science and avoiding predictable mistakes. Advancing with science just recognizes that since the 1940s and 1950s, academia, particularly the development of economic science and financial science, has really advanced. So much so that in 1968, the Nobel Prize Committee created a special category just for economics. So an evidence-based investor is kind of thinking about evidence-based medicine. If you're going to have a procedure of some kind, you want to know that the doctor who's prescribing the drug or the procedure is really up to speed with state-of-the-art medicine, because you want to know that the procedure or the drug that you might take is going to provide you with the highest probability of a good patient outcome. As an investor, we should be thinking the same thing in our investment approaches. There's lots of good academic evidence out there that points to how a portfolio should be constructed, and if we move in that direction, we can increase the probability of a good investment outcome. Now, the second thing here, this avoid predictable mistakes, the reason that's important is because as science has discovered things that work with a higher probability, they've also discovered the things that predictably don't work as well, what we would call kind of predictably disappointing results. One of those that's very common, but it sounds so good, is this idea of market timing. You would think that astute people could look at investment markets and the condition of the economy in the world and decide, hey, the next 6 months don't look very good for stocks, I'm going to get out. Or maybe the opposite, hey, things look pretty good for the next 6 months, so I'm going to get in. It seems like something that people who study markets every day should be able to do, but what the academics find is when people try to do that, they consistently underperform the market. The odds and the statistics on this are really overwhelming, but the idea here is, again, I want to make the market my ally. If I'm doing market timing, what I'm trying to do is to compete with the market, to do better than it. Oftentimes, doing as well as the market, making it our teammate, is really good for us and provides a positive outcome. You know, my last comment there is, may the odds be with you. When you think about advancing with science and avoiding predictable mistakes, really what we're trying to do is put the odds on our side of raising the probability of having a good investment outcome. All 5 of these important ideas for investors right now are with that in mind. We want to construct portfolios based on our personal plans. We embrace uncertainty and we trust the markets to provide kind of a measure of risk and return over time. Then we advance with science and we hopefully avoid predictable mistakes along the way. You know, it's no surprise that the news media is not in the academic education business. I know that's no surprise to anyone out there, but the academics would say that there are reasons to be optimistic when we think about markets and investing. I love this quote from David Booth: "The best antidote to uncertainty is educated optimism." It doesn't mean that when we invest, things will always go exactly the way we want. What it does mean is that we can be optimistic that we're putting the odds on our side as we make investment decisions based on those financial plans that are so important to us. Thanks for joining us today. We hope this has been helpful. If you want to give us some feedback, you can contact us at www.fostergrp.com. We'd be happy to hear from you. We produce these every couple weeks or so. So until the next time, thanks for joining us today.